Thank you. Good morning, good afternoon, good evening around the world. My name is Doug Brunke. I'm the founder and CEO of Global Chamber. We have an important conversation today because our membership and you are more than likely involved with exporting, certainly with global business. And one of the really key topics that we should be thinking about right now, as we get into tax season and we get into I think the most remarkable global business world will ever see next year is where will we be doing business? What are the tax implications? What are the implications overall? And we'll be talking about and focused in on export tax incentives today in a conversation with Eide Bailly. We have two speakers, Gabe Schreiber, who's a CPA and senior manager, along with Mark Griswold, who's also a CPA and an international tax senior manager, both out of Boulder, Colorado. Gentlemen, we've really appreciated the long relationship and support and collaboration with Eide Bailly. I remember one of the more impressive things in the last few months has been a delegation from Argentina where Eide Bailly was instrumental in providing 8 companies with key information about what are the accounting and tax implications for coming to the US for larger companies. And I know you guys work for small, medium, and large firms. And so that perspective of accounting and tax and companies crossing borders is absolutely essential for our team here that are assembled live, and then also anybody watching this video as a recording. Gabe, thank you for kicking things off, and I'll turn the program over to you.
Thanks, Doug. I'm going to share my screen and start the presentation. So I'm Gabe Schreiber, and as Doug mentioned, I'm with Eide Bailly. I'm a senior manager in international tax, and Mark Griswold is here with me, and he's also a senior manager in our group. Quick agenda, so just a very quick introduction to who Eide Bailly is, quick discussion around the different export incentives that are available, and then we'll get into a little bit more of a detailed conversation around the IC DISC incentive regime and the foreign-derived intangible income incentive regime. Yes.
Hey, this is Doug. It's not showing up on the screen, so sorry about that. So try sharing again. It should be good. There we go.
Great.
Now the magic has happened. Let's see what it shows up as. It shows up as an agenda. I'm guessing that's what.
Yes. So yeah, sorry about that. IT is clearly not my specialty. Yeah, so a quick discussion around the IC DISC regime, a quick discussion around the foreign-derived intangible income regime, a comparison between the two, and some tax filings. And then we did leave a little bit of time at the end for Q&A if there are any questions. So please drop those in the chat and we'll try and get to them, or just, I guess, unmute yourself if everyone has that capability. I'm not sure. So Eide Bailly, we are a regional national accounting firm. We have 40-ish offices in the US and India. We're sort of number 20 to 25 on the CPA list, depending on who's counting and what they're measuring. We have offices all over the US. And as I said, in India, I actually think it's easier to look at a map. We have offices and people in every time zone. And so our biggest offices are in Denver, Phoenix, Salt Lake area. Fargo, as well. As Doug mentioned, we've been part of a partnership with the Global Chamber for a couple of years now. We have industry expertise in sort of all of the big industries that you would expect, having offices sort of Midwest and West. We are a full service accounting firm with tax audit being our largest service offerings, but we also have business outsourced, risk advisory, transaction advisory, and we do a lot of CFO services as well. Mark and I are both on the international tax team. Our team focuses on a whole host of international tax issues, but today we're going to be talking about export incentives. and what's available to you. There's two main incentives out there, the IC disc regime, which Mark will speak to, and then the foreign-derived intangible income regime. Both of these are tax incentive regimes that are focused on helping US businesses be more competitive in the global market. The Fdii regime was introduced as part of the Tax Cuts and Jobs Act when the US shifted from a worldwide tax system to what we're calling a quasi-territorial tax system, even though some people would argue we still very much have a worldwide tax system. And the goal of these regimes is to create a benefit for companies that bring functions and sales back into the US and move operations back to the US, or establish operations in the US to do business globally. So with that, we'll get into the IC disc regime. And Mark, I'll just move the slides as you want.
Great, thank you, Gabe. Yeah, my name is Mark Griswold, Senior Manager with Fdii, as Gabe had mentioned. And I will talk to you about the first incentive that we have for you, which is called the Interest Charged Domestic International Sales Corporation. It's a mouthful, so it's more commonly just referred to as the IC disc. The IC disc was first created in 1971, so it's a little over 50 years old. Didn't really grow in wide popularity until about 2003, which is when the so-called Bush tax cuts reduced the tax rate on dividend income. So I'm going to talk a little bit about the benefits, the structures. We'll go into a discussion on the requirements, and then I will kind of show you what this commission is. You'll hear me talk about that a few times. So quick overview of who qualifies for an IC disc. There's multiple industries that qualify. The one you hear the most commonly referred to is the manufacturing industry. It can also be beneficial to people in the agricultural industry, the mining industry, distributors of US produced products, and one service industry that can benefit is the architectural and engineering. If you are a service provider of architectural or engineering services for a construction project that is taking place outside of the US, you could potentially benefit. You want to go to the next slide? So why an IC disc? There's two benefits that you can achieve with the IC disc. The original benefit was the deferral of income tax. That's not, it is still a benefit, but it's not one that's commonly used as much today, especially with the tax rates being reduced in 2003 on dividends. And because of that, the primary benefit that people use today is a permanent tax savings. And how you achieve that largely depends on how the operating entity is organized. Are you a pass-through entity or a C corporation? If you're a pass-through entity, really what you're doing is you're shifting ordinary income into qualified dividend income. And this is through what's called a commission mechanism. And later on, I'll give an illustration of how that works. But let's say, for example, you are in the highest tax bracket for individuals, that's 37% in the US. There's this thing called a pass-through deduction, which lowers the effective tax rate on ordinary income to 29.6%. If you're in the highest tax rate for dividend income, qualified dividend income, that is 20% plus 3.8% potentially for what's called net investment income tax. And so if you take the difference between 29.6 and 23.8, that results in a 5.8% effective tax savings. But again, the actual realized savings is going to be dependent on the tax rate of the individual taxpayer. For a C corporation, C corporations don't get the benefit of a reduced tax rate on dividend income or capital gains like individuals do. So really what you achieve in a C corporation is you can avoid double taxation on the IC disc commission. You're effectively stripping earnings out of the corporation, taking maybe what's called an indirect dividend, where you get the tax benefit at the corporate level. And that could potentially result in 16% tax savings. And I'll provide an example here to show how that is achieved. If you want to go to the next slide. So here's the structure with a pass-through entity, kind of a visual here. So we've got our operating company here in the middle. It's a pass-through entity. The IC Disc is a separate legal entity, a corporation that gets set up as a subsidiary to our operating company. Our operating company will pay a commission down to the IC Disc, and it will take a expense for that commission payment, so it gets a tax benefit on that expense. The IC Disc is a federal tax exempt entity, so the IC Disc does not pay tax on the dividend it receives, and it can then distribute it out the IC Disc on the commission it receives, and then it distributes it out to the operating company as a qualified dividend. So we've achieved a circular payment. Cash goes out of the operating company to the disc and comes back to the operating company. The operating company's overall net income stays the same. However, its classification of income has changed. Its ordinary income is reduced through the commission payment, and its dividend income is increased through the dividend it receives. And so now we achieve that tax savings because we're getting the ordinary tax benefit on the commission payment and then paying capital gains tax on the dividend income. But ultimately, the cash will stay in the operating company. If you want to go to the next slide. So here's an example of some numbers. We have two columns. We have our left column here would be with no IC Disc, and then our right column, we would introduce an IC Disc. So let's assume we have $100,000 of net income from our operating company. Again, we're going to assume that we are in the highest tax bracket for ordinary and capital gains tax, and we are subject to net investment income tax. So the tax that we would pay on that $100,000 of income in the flow-through structure would be $29,600. Now we introduce an IC Disc to the structure, and let's say for this example, our commission expense is $10,000. Our tax now on the operating company's income is reduced to $26,640 as a result of taking that $10,000 deduction for the commission. That commission then gets paid back as a dividend. That dividend flows through the operating company to the ultimate shareholder, and at 23.8%, they would pay $2,380 in tax on that dividend income. So the combined tax with the IC Disc would be $29,020, which is a $580 tax savings by introducing the IC Disc. And that is achieved, as I mentioned in the earlier slide, because we've taken our tax rate on this commission from 29.6% to 23.8%. That's the 5.8% multiplied by 10,000, and you get the 580. Do you want to go to the next slide? So now if our operating company is a C Corp, as I mentioned, we don't really want to make the IC Disc a subsidiary to the operating company because the C Corp cannot take advantage of reduced tax rates on dividend income or capital gains. So with a C Corp operating company, generally you would want the shareholders of the C Corp to be the direct shareholders in the IC Disc Corp. So again, we've got our operating company paying a commission to the IC Disc. It would take a deduction for that commission payment and realize the tax savings at that operating company level. IC Disc pays the dividend out to its shareholders, who individually will pay tax on the dividend income. And so what we are getting here is that indirect dividend that I talked about. The earnings are going from the operating company out to the shareholder through the IC disc. And because the operating company can deduct that payment, you're avoiding double taxation on that so-called dividend out to the shareholder. The downside of this example, though, is that cash is now out of the operating company because cash has to get paid with the commission mechanism. So if the company needs that cash for its operating activities, the shareholder would have to recontribute or loan that money back into the operating company. Next slide. So an example with some numbers with the C Corp. Again, we've got our two columns without and with the IC disc using $100,000 of taxable income. So with no IC disc, the corporation would pay $21,000 in tax. Let's assume it's distributing all of its earnings out to a shareholder. They would pay tax on that dividend income of $18,802. That results in total tax of $39,802. Now we add an IC disc. Again, we'll use that $10,000 commission. Our corporate tax with the additional deduction drops to $18,900. Assuming we're distributing all the earnings out to our shareholder, they would pay tax on that dividend, $16,922. They would also receive the $10,000 dividend from the IC disc. Tax on that would be $2,380. And so now the total tax that that would be paid at the corporate and shareholder level with the IC disc is $38,202, which is a tax savings of $1,600. So again, if we were to take that 1,600 divided by our commission amount of 10,000, our tax savings is 16% of the commission amount. Okay, next slide. So we talked about the benefit of the disc and some examples of structures. So let's go into the discussion of what are the requirements of the IC disc? How can you set it up? And what do you need to do to stay in compliance? As I showed you in the structure example, the IC disc is a separate legal entity, so it requires you to set up a new corporation. This corporation has to be a C corporation. It can be set up in any of the US states or District of Columbia. However, it can only issue one class of stock, and that stock has to have a $2,500 minimum par value. The IC disc also has to maintain separate books and records. And most importantly, it has to file an election with the IRS to be treated as an IC disc. This election is filed on Form 4876-A and needs to be filed within 90 days of the date of incorporation. And that date is important to remember because late filing relief is only available through a private letter ruling, which can become a very expensive process. So you want to make sure you meet that 90-day deadline. The IC disc also, because it is a separate legal entity, is required to file an annual tax return. And probably the biggest thing to note with the IC disc is that you cannot achieve a retroactive benefit. You can only get the benefit from the date of incorporation going forward, assuming that the election is effective the date of incorporation. So this is where careful planning has to come in. If your business is starting to export or if your export activity is growing, it's worth looking at whether that activity would rise to the level that an IC disc would be a benefit, because you need to get the structure in place before that export activity takes place. Next slide. So as far as what export sales qualify for the IC disc benefit, there is a series of tests that you have to go through. The tax code has this term called qualified export property, and only sales of qualified export property can be used in the calculation of the commission. So qualified export property comes down to 3 tests, and I'll briefly go over each of these 3 tests. The first one is what we call the manufacturing test. And as defined, it says property must be manufactured, produced, grown, or extracted in the US by a person other than a disc. So this basically just says that the property has to be manufactured in the US, or if it's agricultural crops, they have to be grown in the US, or the mining industry, the minerals have to be extracted in the US. From a manufacturing perspective, there's really 2 tests you can look at to see if you meet the manufacturing test. So the first one is substantial transformation, which is you're basically converting raw materials into a finished good. The Treasury regulations talk about converting wood pulp into paper or steel rods into bolts. But the key is you are substantially transforming a good into a finished good. The second test you could do is add value to that property inside the US. And for this purpose, we would look at what's the conversion cost, and if there's a 20% conversion cost, then you would be deemed to add value in the US. So the example I like to give here is, let's say you buy t-shirts that were manufactured outside of the US. You import those into the US, and then you put graphics or printing on those t-shirts. So let's say you bought those shirts for $5, and the cost of labor and materials for the printing is another $5. So now our total cost is $10. The US embedded cost is $5, the cost of labor and printing materials. So we have added, of that total cost of $10, 50% has been added within the US, and therefore we would achieve the value added to property in the US, and we would meet the manufacturing test. Next slide. So the second test is the destination test, and this can be one that can commonly trip a lot of people with trying to meet the qualified export property definition. So in general, destination test says that property has to be held for sale for direct use outside of the US. And for this purpose, the US definition includes all of its territories. So for it to be an export sale, it would have to be sold outside of the US territories as well. This can be achieved in 2 ways. One, you're the direct exporter. You sell directly to a foreign customer, you ship to that person, and that person uses the property they bought in their foreign country. You can also achieve this with an indirect sale, meaning an indirect export sale, meaning you sell the property to someone in the US, but the property is ultimately delivered and used outside of the US within 1 year after your original sale. And this is where distributors can benefit from the IC disc. So let's say, for example, you manufacture product, sell it to a US distributor, and then that US distributor resells the property for export. In this case, you as the manufacturer of the good that's ultimately being exported could benefit from the IC disc, and the distributor could also benefit because the property they are selling, as long as it meets the 3 tests, even though they weren't the manufacturer, they can still benefit because they were the exporter. two important things to note, though. One is that if the property is used or further manufactured in the US before it is exported, the destination test is voided and you would fail that. So you need to be aware when you sell for export, especially if you are delivering within the US, that you know what the buyer is going to do with that property, so that you can structure the sale in a way to make sure that there's no use of that property in the US before export. The second item is there's this proof of compliance, and the seller has the burden to prove to the IRS that the property was exported. If you cannot prove that, then you are deemed to fail the destination test and you cannot use that sale in the IC-DISC calculation. The Treasury regs list documentation that can support this. Pretty much you just need to have the export documents to show that that the property was being exported. And so if you are not the exporter of record, you need to make sure that you can get those export documents from the actual exporter so that you have them on file to show that the property was ultimately exported. Next slide. The last test is called the fair market value test, and states that no more than 50% of the fair market value of export property can be attributed to imported materials. So if we go back to that shirt example that I had a little bit earlier, so we bought that shirt for $5. That shirt was made outside the US and imported. We added our printing to that shirt, and let's say we resell it now for $20. So $20 is the fair market value of the exported property. That's what we're selling it for to our customer. $5 is the value of the imported materials. That's what we bought the shirt for. 5 divided by 20 is 25%. So 25% of the ultimate sales price was attributed to imported materials. And since that is less than 50%, we would meet this test. And so really at the end of the day, you have to look at all these three tests together to make sure that the property being exported is qualified export property under the tax code definition. For example, if you were to import, say, this shirt for $5 and then you just resell it for $20, but you don't do anything to it, you would meet the fair market value test. You would meet the destination test, but you would not meet the manufacturing test because there was no value added to that property in the US if you just import something, mark it up, and resell it for export. All right, next slide. So the last thing I want to talk about really is just the commission. We talked a lot about the commission being paid and distributed out. The commission is ultimately what drives the IC-DISC benefit from a monetary standpoint. The higher the commission, the higher the tax savings that you'll realize. And so how you calculate that commission, you effectively have to calculate net income on your export sales. So you take what your gross receipts were, subtract out your cost of goods sold, subtract out an allocation of SG&A costs, and then you get your net income, which in the IC-DISC world is referred to as combined taxable income, or CTI. Your commission is then 50% of that combined taxable income, or 4% of the gross receipts of the export sale. Whatever the higher calculation is, that is the commission that you can take on that sale. There's also a marginal costing method you can use. Marginal costing is effectively an alternative way to calculate combined taxable income. And there's also what's called a no loss rule, which basically says your commission cannot exceed your combined taxable income. So for example, if we have a $100 sale with $2 of net income, Under the 4% method, our commission would be $4, 4% of 100. However, because our net income is only $2, our commission would be limited to the $2 of net income. You cannot create a loss through the IC disc commission. So as I said, the higher the commission, the higher the tax savings. Generally, the higher the company's profitability is, the higher the commission will be. And so therefore, if we're looking at an IC disc and what makes sense, we want to make sure that our tax benefit that we're going to achieve will exceed the cost of compliance to implement the IC disc into our structure. And so what I've found is it can be achieved with as little as maybe $1 million of export sales, but once you hit kind of that $2 to $3 million in export sales, the IC disc is probably going to be providing you a net benefit, and is definitely worth looking into whether adding this to your structure would be a benefit. And I think with that, Gabe, I can pass it off to you for Fdii. Oh, sorry, I have one more slide. This is just a quick example. I'm not going to go into detail on this, but the IC disc allows you to calculate the commission on a per transaction basis, and generally by breaking out all of your export transactions individually, you can achieve a higher commission than if everything was grouped together. And as I explained earlier, the higher commission, the higher your tax savings. So this is a good benefit of the IC disc. And now I'll pass it over to Fdii.
Thanks, Mark. So I'm going to talk about foreign derived intangible income, or Fdii, as we like to call it. Fdii is a tax deduction that was added to the code as part of the Tax Cuts and Jobs Act in 2017. And it was added to the code along with global intangible low taxed income, GILTI deduction. So the GILTI regime is part of an anti-deferral regime, and it is sort of a big change in how we tax multinational companies. And so as part of the Tax Cuts and Jobs Act, they also added Fdii. So they often refer to GILTI as the stick and Fdii is the carrot in terms of incentives for businesses. So they're both of those deductions are contained within section 250, which is important for a reason I'll go over later. It provides a 37.5% deduction on qualifying income after expense apportionment, which brings the effective tax rate down to 13.125% for Fdii income, which is not a bad tax rate for a corporation whose headline rate is 21%. But the Fdii deduction is scheduled to decrease to 21.875% for tax years beginning after 12/31/2025, which provides an ETR of just under 16.5%, which is still better than 21%. It will be interesting to see with the elections how some of these things are impacted as the TCJA Act is reevaluated for expiring provisions and changes like this to see what happens. But right now, the deduction is scheduled to decrease. Fdii is only available to corporations or LLCs taxed as a corporation. So importantly, it is not available to S-corps, REITs, and other pass-through entities. It's also not available to individuals. If a partnership has qualifying activity, there are special rules for that, but they basically pass that activity out to their partners. And if there is a US corporate partner, they can still take an Fdii deduction. Qualifying activities, similar to the IC disc regime, there's a very tailored activities that the Treasury wants to provide the benefit to, which is basically sale of goods, provision of services, or the licensing of IP to foreign customers. there are very specific rules for determining when property or services are sold for foreign use. There are more rules if they're sold or provided to related parties. So it's not that you can't claim the benefit, but there's just additional rules to work through. And as I mentioned earlier, the Fdii and GILTI deductions are both contained within Section 250. And a Section 250 deduction is limited to taxable income. So if the corporation is not does not have positive taxable income, it can't benefit from these deductions. And so our startup companies or corporations that are still utilizing NOL may not be able to get the full benefit. But if we have corporations that are profitable, have taxable income, and are paying tax, Fdii can be a very easy to implement deduction. It does not require a separate legal entity. You just need to have certain documentation in place and I'd be able to identify your foreign sales and your foreign services. And because it does not require a separate legal entity or a specific structure in place, oftentimes as we're talking to clients, it is very easy to sort of work through the data and take an Fdii deduction. And it's not entirely free, but it's almost a free deduction because most of the work is generally done already. You just have to be able to identify it and put it on your tax return. So there's a lot of acronyms in Fdii, and one of the later slides goes through them, but foreign-derived deduction eligible income, FDDEI, is either foreign sales or foreign services. So if we have foreign sales, it's pretty much if you have income derived from the sale of property to any foreign person for foreign use, which is an important part of the regime. The property cannot come back to the US. So if you have t-shirts, to Mark's example earlier, and you're selling to customers in Canada, that's a qualifying sale. If you have IP that you're licensing to customers in Canada or Mexico, that would be a qualifying sale. And foreign use is defined to mean consumption or disposition outside of the US. Importantly, foreign services also qualify, and those are defined as income derived in connection with services provided to any person not located within the United States. So pretty much if you have a service business and you have customers in Europe and you're providing services to those customers, that qualifies. The services may not need to be performed inside the US, but there are certain limitations to how the calculation works that if the services are performed outside the US, they may not qualify, but you would have to analyze it to get into the specifics. One point that's important to not overlook is that the gross foreign sales and services income has to be reduced by expenses. And so for those people that have worked through some US tax calculations, there's code section 861 that tells us how to allocate and apportion expenses. Those rules apply to Fdii as well. And so when we look at a tax return and we're doing a Fdii calculation, you have to look at all of the expenses that are being deducted and allocate them either against the US source sales or the Fdii sales and get to sort of a net number. And the sum of foreign sales and services is what's called deduction eligible or foreign derived deduction eligible income. The mechanics of taking an Fdii deduction are very clear and spelled out in the code and regs. This is a lot of words. I also have a slide here that sort of is maybe easier to visualize, but there's many steps that you have to go through. The first being the deduction eligible income, which is essentially gross income excluding certain items, which are again spelled out, but GILTI, subpart F, and importantly branch income are excluded from DEI. If you have a very basic domestic corporation without foreign subsidiaries or foreign operations, most of the time your deduction eligible income is going to be your gross income. The name foreign derived intangible income, it's a little bit of a misnomer because the qualifying income does not need to be intangible in nature, but it gets that because you have to reduce your qualifying income by your what's called deemed tangible income return, or basically a company has to know the tax basis of its US tangible assets. So those are the assets that we depreciate. And you have to know your tax basis under the ADS depreciation system. And whatever that number is, if it's $1 million, 10% of that is your deemed return. So the Fdii amount is reduced by the deemed tangible income return. Hence, they call that intangible income because it's in excess of the tangible income return. So it's not required to be intangible income, but when they wrote the rules, they decided that a routine return on tangible property would be 10%. So anything above and beyond that must be intangible. And that's why it's called the Fdii as intangible income. You then have to calculate your deemed intangible income, which is basically what I just talked through. You take your DEI, subtract out 10% of your tangible assets. We call that QBI, which I realize is not on this slide, but that's just the acronym we use. That gives you your intangible income. You then have to calculate your foreign derived eligible income to come up with a ratio. And then you work through the rest of the steps. I think this slide is a lot easier to see it. So once you're in step 2 and you have your deemed intangible income, it's the ratio of your foreign derived deduction eligible income over your total gross income. You take that number, times it by your DII, and it gives you your foreign derived intangible income amount, which is the Fdii amount. And then that times the applicable percentage, which right now is the 37.5. It's going down to 21.875. The Fdii times that number is your deduction. So it's a lot of words. It's a lot of acronyms. I often have to go look up what they all mean sometimes because it's a lot of letters, but at the end of the day, it's basically your foreign sales in excess of your 10% of your fixed assets. You create a ratio and you work through the math. We have some documentation requirements to work through, which when the rules first came out, the documentation requirements were quite onerous, and surprisingly, Treasury relaxed those documentation requirements and in effect turned them into basically what would normally be considered generally available business records. So things like an invoice or a contract with the customer address being foreign, proof that you ship the goods internationally. If you're licensing IP, you should know where that IP is being used. It's usually part of the license agreement. It can't be used in the US. So there are certain things to work through that you want to make sure you have the documentation requirements in place. But it's good to know that they were relaxed, and it is generally your business records should suffice. There is a small business exception to the documentation rule for businesses with gross receipts up to 25 million. So if you find yourself in that startup phase and maybe your documentation isn't as clean as we all want it to be, or you're just a small business and we're running around a little bit with our hair on fire, then the documentation requirements don't apply, which is nice. A basic example, we have a US corporation with 12 million of revenue, all from services provided to foreign customers, and they incurred 7 million of expenses. So we have taxable income before Fdii of 5 million. So in this example, our Fdii would be the 5 million since there's no other income or expenses. And the Fdii deduction would be the 1.87 million. And taxable income after the deduction would be the 3.12. Calculate corporate tax on that. And the ETR of 656,250 of tax on 5 million of taxable income is 13 1/8. This is a relatively simple example. One that maybe has both US and foreign source income and expenses that would be allocated to both. So assume we have 150 of revenue, 50 is US revenue, and 100 is foreign. There is 75 of expenses to allocate, and so DEI is 75. We allocate the expenses pro rata, so 25 to the US and 50 to foreign. We have 150 of fixed assets. 10% of that number would be 15. So we start working through the steps. We take our deduction eligible income, which again is pretty much just gross income, less the $15 of return on fixed assets. And we get the intangible income of 60. The foreign derived deduction eligible income from above is $50. The deduction eligible income is 75. So our ratio is 67%. Note that the ratio cannot exceed 1. So we take our deemed intangible income of 60, we apply our ratio and get Fdii of 40. The deduction then is 37.5% of that, or 15. So Fdii is 40, taxable income is 40. There is no need to reduce Fdii by a taxable income limit. So our fee deduction is 15. We don't reduce it at all. The tax is on the foreign income is 5.25, and so the ETR. So we have Fdii income of 40. We take a $15 deduction. Our net Fdii is 25. 21% of that is 5.25. The ETR on that is 13.125. So a little bit of a very simple example, but you can see how you need to allocate expenses and work through the different steps to get down to the $15 deduction. We have about 6 minutes left. I want to leave time for Q&A. Mark, do you want to quickly talk through the different tax filings for an IC disc? I know you kind of touched on it, but we've listed out the forms here.
So just kind of some of the tax filings you have to think about with the IC disc. So as I mentioned, you have to file an election at the very beginning. That's on a form 4876-A. The IC disc has to file an annual tax return, which is filed on form 1120-IC disc. Then you have this form 8404, which I didn't mention this earlier, but if you do the tax deferral benefit of an IC disc, you have to pay an interest charge on the deferred tax. And so form 8404 is the form that's used to calculate, report, and pay the interest charge on that deferred income. The interest charge has to be paid at the ultimate taxpayer level. So if the IC disc is owned by a pass-through entity, the pass-through entity has to inform its owners of what their share of the deferred income is, and then the owner would calculate and report that at their level. And then also at the owner level, if you're receiving dividends from the IC disc, you would report that on your shareholder tax return. Dividends from an IC disc are reported out on what's called a Schedule K, which gets filed with the IC disc tax return. So they do not get reported on Form 1099 DIV, but instead are on Form Schedule K.
And then for Fdii, there's a specific form, the 8993, which is where you report your 250 deduction. So it contains both the Fdii deduction and the GILTI deduction. If it's a partnership that has the qualifying activity, Schedule K2 Part 4 would be used to break out the Fdii activity for partnerships with corporate partners. Notably, an S Corp can only be owned by individuals, so there's no need to report Fdii activity out of an S Corp. There is some small differences. I don't know that we can go through all of this. I would say the big one is the structure requirement, and then also the qualifying sales. I see Doug came back on camera, so he's going to tell me to wrap it up. It's important to choose the right incentive for your business. There is some overlap rules where you can maybe claim both incentives, but they both create deductions. So there's a little bit of a circular calculation that you need to work through to model this out and make sure you're taking advantage of both regimes as effectively as possible. And so with that, Doug, we kind of breezed through the last 2 slides, but I'll open it up to questions or anything you want to add.
I don't see any questions in the chat, but does anybody have a question? Just unmute yourself and go ahead. Amazing information, by the way. It's just so detailed and so comprehensive. It's a great primer. You've done this before.
Mark has done this a lot. Yes, I've done it a few times. We did put our emails here. If you want to reach out to us, I'm going to stop sharing my screen here. But Doug, I think you have these slides. You can circulate our emails if anyone has questions.
Sounds good. Because we have our next event coming up, I'm going to suggest that, unless somebody has an urgent burning question, that we connect up with our speakers today separately, whether you're live or you're watching the recording. Take a look at that information and connect up with them directly. And if there is any question and you have trouble, I'll just send an email or connect up with Global Chamber, and we'll be happy to make the introduction. Any final comments that you would like to make, Gabe? What kind of, from a high level, what would you like to leave people with?
If you have export sales or export services, ask yourself if you're taking advantage of these benefits, because some of them can be very easy to claim and some of them take time, but margin is tight. And if you can save a couple percentage points on tax, it's usually worth it.
Based on what you've seen when you walk into a new situation, what percentage of people are taking full advantage of this?
At the largest companies, all of them. At the middle market companies, it's probably 50%, and it's only the ones that have a international tax advisor that's made them aware of it. We oftentimes find companies who's have qualifying income and are not taking advantage of it because they're unaware of the benefit that's available.
Thank you again for the great information. Everyone have a great rest of your day. We're going to jump into a global sales conversation right now, but we're going to end this call. Thank you, gentlemen. Have a great rest of your day.
Thank you, everyone.
Thank you so much.